is that, do you guys know about this AHTF crew? Is that you can't quit this crew. Like, I missed you so much, so I had to come back. In all seriousness, not that I didn't miss you. Please hold good thoughts for Glenna, my co-facilitator, who's going to be here today. She took a fall this morning, and she broke a few ribs, and so she is recovering. So I'm here to be in fierce support and keep it going. And fortunately, we've got like 3 amazing presenters today, so lots to share. So it works out that we're in this education phase and that we can keep moving. Okay. And so to that end, we're not going to do any reflection on the past meeting. And largely the reason is you all were able to get a lot of questions answered in real time of our presenters, the 2 Mollies. And so the thought was no need to kind of deliberate and reflect on what were some takeaways from that last session. And so we're going to skip over that. And we're actually just going to jump right into deepening the understanding. So to our speakers, I am Tasha Jones. I've been the facilitator for the previous 6 months, and I have a co-facilitator who is going to be guiding the task force into prioritizing some recommendations in the end. And so today, what they get to hear from you is the topics that you're covering today to help them deepen their understanding, is to help inform some of the recommendations and suggestions that they'd make to the city. So without further ado, I would like to, David, I can pass the baton. Yeah. And David, if it's easier, you're welcome to, since we don't have a podium, you're welcome to use one of these mics and sit and present from the mic. Yeah, there you go. Yeah. And then, exactly, perfect.
All right, can everybody hear me okay? It sounds like it. I hear myself, so that's good. All right, so nice to meet everybody. My name is David Foust. I am a commercial loan officer at CHAFA, the Colorado Housing and Finance Authority. I work on our loan originations team, which we have been tasked with administering a portion of the Prop 123 program. We have a few different ones, and I'll go over those here in a moment. CHAFA's primary role and a big piece that they play in the housing spectrum is that we allocate federal housing tax credits. And so we allocate the 4% and the 9% housing tax credit on the federal side. Every state has some sort of an entity that allocates these credits, and every state's entity that allocates the credits are all a little bit different. Some do more lending, some are more focused strictly on the federal programs, and some states have affordable tax or state affordable housing tax credits that go along with it. So the housing authorities play the finance agencies play a pretty pivotal role in administering those funds. So I am here to not talk about your strategic vision. I did not come up with this, but I suppose we could all be reminded, so we'll maybe reflect on that for a moment.
You can go ahead and advance to your section. Yeah.
So I am here to tell you a little bit more about Prop 123. This was a voter initiative that was approved, I believe that was in 2022, and we have been rolling this out. And so the way it was divvied up in there's essentially 2 segments to how the dollars are divvied up. So we have the Affordable Housing Support Fund, which goes through the Department of Local Affairs. They get 40% of the funds coming from the State Affordable Housing Fund. This goes to fund like homelessness support initiatives and homebuyer initiatives, things like that. The other portion, 60% of it, comes to OEDIT, the Office of Economic Development and International Trade, and CHAFA has contracted with OEDIT to administer those funds. And so in this first year, there was about $160 million that was available as part of the fund, and of that $160 million, we ended up with about $96 million of it to administer through CHAFA and the programs that we administer. So there's a couple additional ones that I'll touch on here too, but the primary bits that we have at CHAFA with the Affordable Housing Financing Fund, we are focused primarily on the construction and rehabilitation of housing units with our programs. And so we have a land banking program whereby nonprofits, governmental entities can receive loans or forgivable loans or grants to acquire land for the future development of affordable or middle-income housing. And I believe that also may include attainable homeownership housing as well. And we allocate anywhere from, according to statute, about 15 to 25% of our total allocation of funds to that program. We have our equity program. That round we actually just had recently, but this makes equity investments into multifamily apartment homes for individuals up to 90% of the area median income. So this is more middle income housing. And then our final program is our concessionary debt program, and there's kind of 3 sub-programs under this one, but the broader perspective on concessionary debt is that this is subordinate financing for multifamily developments. And what that ultimately is, think about like a second mortgage or something like that. And so this is at a really low interest rate, so in a high interest rate environment like we have right now, although it's not historically high, but it's certainly higher than what folks were used to over the last decade. So it helps take a bite out of some of that interest rate cost and enables projects to take on a little more debt, which of course requires less subsidy otherwise. So first I'll go over land banking, and this program is actually administered through our business development office. So this one's not actually directly under my purview, but the real goal of the land banking program is to set aside land whose predominant use in the future will be for affordable housing. And I hope you can see that. I know it's kind of small, it's a lot of text, but some of these programs are very complicated, so it's kind of hard to, very much a, images over text on a slide person, but it's kind of important to get this text up here. So, but we can provide grants to local governments, tribal governments, public housing authorities, but we can also work with nonprofits, and we can do forgivable loans if they meet milestones. We have essentially development milestones. We want to see them making progress on their award. So if they are awarded, I believe it's after year 5, they need to have a development plan in place, and then by year 10, we would have expected them to start construction. And at that point, it could be a forgivable loan. I'd already mentioned that about 15 to 25% of our total funding allocation goes to this. I believe in the past year we maxed that out. We had about 23-ish million, I think, which I believe is on a slide coming up, so I will confirm that in a moment. But we need to make sure that, I had mentioned earlier that forgivable loan piece. As long as zoning is in place, development plans there in 5 years, they're making that progress that we talked about, and then we want to see that they have gotten their permits and have gotten funding in order to actually start construction on building out the site within 10 years. So those are kind of the big milestones that we want to see. This is primarily if you're doing rental housing, it needs to serve residents at 60% of the area median income and below. This is similar to the federal housing tax credit requirement for affordability. If we're doing home ownership, this is more like attainable home ownership. So those products need to be available to individuals at 100% of area median income and below. And I assume everybody's familiar with AMIs and area median income at this point. I imagine that's probably been covered at some point. So I just wanted to make sure. There's a lot of acronyms in this industry. So. And there's some other details in there as well. We allow them to adjust their rent and income limits according to the Department of Housing and Urban Development's limits. And those, of course, vary by county and household size. So if you have 2-bedroom units versus 3-bedroom units and so on. Rural resort communities doesn't necessarily apply to Inglewood, but they could petition for higher AMIs. Some of those communities have a need for more middle income housing, and so there is a carve out in statute that enables them to do that. But the priorities for this program, and you'll see this is kind of a theme for the other programs, is that we want to see high density housing. The state is really interested in getting as many units out of the ground as possible. I think they're kind of subscribing to the classic idea that if you build more supply, that should put a damper on prices rising, and so they want to see as many units as they can, at least of course, given the local geography, right? Whatever zoning will allow, they want to see the maximum that's allowable on a site. The next thing they want to see is mixes of incomes. The way that we've kind of approached this is that we want to see, if you have to average 90% AMI, I want to see some 70% AMI units and some 90s and some 110s, and just kind of have a good income mix in each individual property. And finally, there's environmental sustainability guidelines that are out there. For most of the programs, they are fairly stringent. They're certainly more stringent than you would see in a typical just market rate type development. They're very similar to what you might see with affordable housing development standards. You need to have a green certification. The state is very adamant about electrification right now as meeting some green certification goals. We want to see water-wise landscaping, be located close to a transit corridor, stuff like that. So this first round we had 25 million. I was right. It's right around 25 million. We had 113 LOIs, letters of interest, that came in, and they were requesting more than $255 million. So as you can see, it was a bit oversubscribed. It made it a very competitive round. They then whittled down the list to 26 projects and invited them to submit a full application so we could provide a little bit more analysis and review on those projects. They could receive up to $5 million, and the jurisdiction needed to make sure a part of the Prop 123 process is that the jurisdiction has to opt in to be able to receive the funds. The good news is that can happen at the county level, it can happen at the city level, municipality level, and so on. But I believe the last update that I got, and this is now a little bit out of date, but I think it was something like 88% of all Coloradans are covered by a municipality that has opted in. So most municipalities have opted in at this point. All right, concessionary debt. This is more into my wheelhouse. So as I mentioned before, the concessionary debt program provides subordinate financing. So we're looking at second mortgages, things like that, to help bring the interest rate down on the debt on the projects. And this serves low and middle income developments. We would like to also see modular. Well, in this piece, we had modular and factory build providers. So there's companies out there that will essentially prefab buildings for you, or at least make them in a factory. It's usually a bit faster as a form of construction. It's generally a little less wasteful as well. And so the state is very interested in seeing the modular industry continue to grow. And so a part of this was also providing some loans to those modular factories to help build their capacity to meet demand. We offer below market interest rates on these. Right now, market interest rates probably anywhere from 6.5% to 7.5%, depending on who you're working with. The interest rate on these loans is 2.5%. And so it takes a pretty big bite of the apple out of a deal. Let's say maybe you've got $10 million in a loan at 6% or something. If we come in with 2.5% debt, you can probably take your total debt load up to 11.5, maybe $12 million. And that goes a long way on a lot of these deals that are kind of operating on some pretty thin margins. These are available to tribal governments, governmental entities, for-profit, nonprofit development teams. We allocated, in this particular round, I believe we allocated the maximum as well. About 35% of the total pie was allocated to this in this round. We have this flexibility year to year, so as we kind of see demand for the products waver one way or another, we can be flexible about how we allocate the funds. In general, we expect to see a 60% average AMI for the restricted units on these developments. But if there is a senior lender, sometimes Fannie Mae and Freddie Mac will have like middle income products where they require 80% AMI. In those instances, if we are the subordinate debt, we will defer to that senior lender's requirement. So this program does enable us to touch on some of those middle income deals as well. Again, the priorities that we have there, you'll see it's high density housing, it's mixed income housing, it's meeting those environmental thresholds. So those are the same priorities that we have as we had with our land banking program. So I mentioned before there's kind of 4 pieces on this one. We divided this program up into a multifamily finance, tax credit gap finance, tax credit pre-development finance, and then our modular. And the multifamily finance is for deals that are seeking to provide this affordability, but they are not using tax credits. The other 2, the tax credit gap and tax credit pre-development, are for deals that are looking for federal or state affordable housing tax credits. And so The multifamily finance portion was, I think, challenging for a lot of folks. It's very challenging to deliver affordable units without some other form of subsidy. Even with really cheap debt, it can be very, very challenging these days, especially with high construction costs and especially now with high interest rates. And so, that one I think is challenging for us to meet, but there were certainly some applications that came in that were able to make it work. They were creative, used some modular construction techniques, usually help save on cost a little bit, things like that. So it's interesting to see that, and I'm excited to see how that evolves going forward. The other two, tax credit gap and pre-development, are pretty straightforward. Tax credit gap is if you've got a deal that has been awarded tax credits and you have a gap in your financing, we can come in as a gap source. It's still a must-pay source. They still need to pay it back to the state so we can ensure that this program can continue in the future and funds are available in the future. Pre-development is, it's expensive to do development deals. Oftentimes, tax credit deals spend over $250,000 before they even apply for tax credits. And by the time you've gotten through a lot of it, I mean, your pre-development expenses and development expenses are, it depends on the deal, but it's going to be quite a bit. So we're offering these low interest loans to help with those pre-development costs for entities that maybe aren't as well capitalized as other ones. I mentioned before the modular finance. This was providing loans for companies that are doing factory build modular housing. And so we're helping to try to expand their capacity, which of course we hope that it would help them meet the demand from development teams that are using modular construction. So for the multifamily tax credit gap and tax credit pre-development, we had an application window from September to October of last year. We had about $15 million to allocate. We had, once again, a whole bunch of requests. 38 applications came in requesting $113 million. And we awarded 7 applicants to move to the full underwriting phase, and that represented about 722 units of housing. So we felt pretty good about the amount of units we were able to get to with that, and I'm looking forward to hopefully maybe doubling that number next year. We'll see. Depends on what comes in with the next round of funds. This first round of funding that we had was kind of halfway through the fiscal year, so it's half of what will be available in most years. So, we're thinking it might be close to $320 million as the total pie for the upcoming year, and so 60% of that will be coming to CHAFA for our programs to administer. So, just maybe imagine some of the numbers I mentioned of how much we have allocated as just doubling that for next year. The modular applications, again, this was primarily for factories to produce modular construction. We allocated $18 million for that. I don't know in this coming year that we're going to do that again. This was mostly just to kind of kickstart that industry a little bit, but we may be looking to allocate some funds specifically for projects that are using modular construction so that we can help continue to support that industry as they grow. So equity, I think, is kind of the big and interesting one. It at least is for a lot of the developers out there, because equity is kind of challenging to come by these days. With higher interest rates, there are different investment options for a lot of the investors that are out there. And so equity financing in real estate is a little more challenging today to get. It's not impossible, but it's a little more challenging than it was over the last decade or so. And so this equity program has been of particular interest, not only because it's available, but primarily because it is very concessionary when compared to traditional equity. And so the types of developments that we're looking for in this one, it is lower income, it's also middle income developments, but it's also available for the preservation of existing developments that have affordability that may be at risk of being converted to a market rate property. And we're not allowing folks to pair this with federal or state housing tax credit equity. The reason for that is typically with tax credit equity, the returns on that equity are coming from the use of the credit. So if you have income taxes, you'll use that credit against your taxes, but the state doesn't really claim a credit against itself. It just doesn't really make a whole lot of sense. And so the incentives are just kind of different and they don't really align well. So it needs to stand alone, or it can be paired with some other private equity if you find another private equity investor. The program is very flexible. A lot of equity investors require a certain level of return and other targets that you have to meet. We actually don't have a set return amount. The reason for this is in Prop 123 in the statute, there's something in there that created what was called a tenant equity vehicle. And so all the returns in the program above and beyond our principal investment are supposed to be contributed to this tenant equity vehicle. And the tenant equity vehicle, we haven't finished the program design for it, but traditionally those typically look like a monthly cashback rebate to residents or an annual disbursement back to the residents as well based on the performance of the property. In the past, we've primarily seen this done on a fairly small scale, so payments tend to be $20 or $30 for a monthly rebate, and then the annual distribution might be a few $100s. We think with the scale of this program being a state level program and as it continues to grow and mature that these can be much more significant. The statute's intent was to create this as a wealth building opportunity for low and middle income residents, and so we're being very intentional about looking at projects and trying to determine how they'll contribute into that tenant equity vehicle, but more importantly, how can we design that tenant equity vehicle to benefit the residents? And so based on my initial modeling, I mean, we could be seeing monthly distributions that probably in line with what we see elsewhere, 30 or 40 bucks, which isn't huge, but comes in handy. But I think the annual distributions based on how much funds we're investing here could be, they could average as much as $1,000 to $1,500 per year for residents, which is huge. If you're looking to build emergency savings or save for a home, things like that, it can really kind of help jumpstart that. The maximum investment amount on a per project basis we're able to do on this is $15 million. This is mostly kind of relative to the amount of funds we have available. We're not trying to put all our eggs in one basket, but we also recognize that too small of an amount, we won't really get a whole lot of units out of the program. Development is expensive, so the numbers may seem huge, but they don't go as far as you think. The minimum investment size we said was 1.5 million. That was primarily due to the fact that as you get down to a certain size in development, financial stability becomes kind of a challenge. If you experience, if you have a 12-unit development and you get a vacancy that's for 6 months, I mean, that's a pretty significant hit to how the financing performs on that project. And so we were kind of looking for the balance in between. We also wanted to make sure that we were hitting funding levels that were appropriate for maybe rural developments or smaller developments where you can't support, a 50 or 60 unit development, but you can certainly do, maybe 16 units or something like that. The eligible uses, this is equity. It's much less restrictive than debt. It comes in at construction. You can use it on pretty much anything as part of the development process. I mentioned before that we don't really have a return expectation, so to speak. So, most equity providers will say we need 8% back on our money every year. We don't say that. We basically say we want to participate in whatever cash flow is available coming from the property, and then whatever that cash flow is, we're going to put that into the tenant equity vehicle. And then at the end of the investment term, they'll pay us back the principal amount of our investment. And so it's, in that sense, it's very flexible source, and it's much less, I think, financially demanding on the properties, and that helps us enable these development teams to develop properties that are more attainable or more affordable than market rate property otherwise might be. As I mentioned before, this can't exceed 90% AMI. In this first round, we saw the average of projects coming in was about 80% AMI is about where most of the projects ended up. So it's kind of squarely in that middle income bracket. And then placement fees, fun stuff, you don't need to worry about that. But the affordability requirement, we require that the properties maintain that affordability level they represent in their application for 30 years, starting from that investment date. And so they, of course, can notify local government. So we have something called a first notice. They essentially have to notice local government or other interested entities 2 years before that affordability restriction expires, so that perhaps those interested entities that may be interested in preserving that affordability have the opportunity to acquire the property and then ensure that affordability for longer than that 30 years. And we kind of pick that 30 years too because, if you think about if you buy a house and you're going to have to rehab it after 20 or 30 years, you have to do some pretty significant work. There will be a new capital investment needed at that time. I mentioned the tenant equity vehicle a little bit before. We'll have ongoing compliance and reporting. We'll have to verify incomes of residents and things like that. But again, we have the tenant equity vehicle that we're going to be setting up. We're still in the midst of that. We're going to be sending out an RFP, looking at evaluating responses from providers that are familiar with administering a tenant equity vehicle, because that's a little bit outside of CHAPA's wheelhouse. And so we had around very recently, the applications were accepted from mid-March to mid-April. We were just finishing up the review on those applications, and I do believe there's probably a public release of the awarded applicants that should be coming out in the next week or two. So keep an eye out for that. We had 36 applications come in. We had 38 million available and 313 million in requests. So once again, very oversubscribed. It was very hard to kind of whittle it down. The average request size was just shy of $9 million, and the average project size was about just shy of 110 units. And so these are pretty significant developments. As far as the equity goes, we have 38 million here. We'll probably have about double that for next year. But you usually put, well, depending on the project type, if it's a market rate development, there's usually more debt than there is equity because there's cash flow that can support the debt. Whereas with middle income and low income developments, there's usually more equity than there is debt because there's less capacity to support the debt. So in this case, we had 38 million to allocate, but each of these projects have more significant requests for equity to go in there. So again, seems like a big number, but it doesn't necessarily go as far as you think it might. So I think I got through that in about 20 minutes.
Yeah,
I
you
wasn't
did
timing
perfect.
myself, but happy to answer some questions now or later if
Yeah,
time
let's open it up
allows.
for questions if there are any.
Red light. Where will we can get a list of the housing units that will be available for 30 years? Will there be a list of affordable units?
Yeah, so when the applications came in, we published a list of all the applications that we received. And then once we've announced the awards, there will be a list that's published with the awarded projects as well. I believe that's going to be published. Okay, you ready for this? Actually, it's on the bottom right there. I'm good. The longest website ever, the Colorado Affordable Housing Financing Fund.com. It should be published there.
Thank you.
Uh-huh.
There you go.
Tech issue tonight. Maybe this is the
Got
only one that's going to
one
work.
working mic on that side of the table.
Thank you so much for being here. I'm Chelsea Needham-Camp. I'm a city council member here. I've got a couple questions. One is your work and the work of a lot of other agencies and organizations are focusing on the preservation of affordable rental units. We don't see as many preservation options for sale units or starter homes that are being scraped and made into more luxury units. So I'm curious if the state is thinking about anything along those lines. And then my second question is, I'd love to hear more about what makes cities competitive as you're doling out this money. Obviously, there's 10x the demand than what you have to allocate. And as the years continue, will you consider spreading out the geographic areas that are getting it, or is it more on the prioritization issues that you mentioned? But I'd love to learn a little bit more of the inside baseball about how those decisions are made.
Yeah, absolutely. So to your first piece for the home ownership, so we have a small portion of our funds can be used for home ownership. And in some ways, we're kind of at the mercy of what projects or what proposals come into us. But the other piece of that is that there are home ownership support opportunities through DOLA's portion of the funds. And so CHAFA is, we do have some, first-time homebuyer programs, things like that, other single-family housing affordable, or not affordable, but single-family housing programs that we administer, but not necessarily from Prop 123. And so for more on the DOLA side of things, I would probably recommend seeing if you can get somebody to come in to speak a little more to how they've set up their use of funds, because I'm not as privy to it as they otherwise might be. But as far as how we're making our funding determinations, so I'm glad you brought that up because I didn't necessarily have that covered here. The way that we're approaching reviewing the application is the state wants to see a good balance of where funding is distributed, especially throughout the entire state, right? We don't necessarily want all of the funding just going into one locality because that's just not really fair or equitable. So the way that we're looking at it is, again, the priorities that the state offered us was, we want to see, well, I shouldn't say offered us, but basically told us that they want to see as many units as they can get out of it. And from there, it's really kind of looking at it from a geographic distribution. And so if we have, let's say in our concessionary debt round, right, we had 7 projects that we awarded. And, as we're looking through that, I think we ended up with 4 of those deals being in urban geographies and then 3 of them being in rural geographies. And so I think we had 1 deal in Fort Collins, I want to say there was 1 or 2 in Denver and 1 in Colorado Springs. And then the other 3, I believe 1 was in Frisco, I think the other was in Pagosa, and then the other was, I forgot. It was a rural geography. So we do look at kind of the broader geographic distribution, but within, like, say, within Denver specifically, it kind of becomes, Denver proper versus Denver metro, and we do look at that and try to evaluate based on that. But as far as the priority goes, if we get down into the single metro, I think housing units really is kind of the first priority that we're looking at, and then the second priority would be if we have 2 different projects in Denver that are of similar size, similar requests, and things like that, but one's Denver and one's Inglewood or something like that, we would probably opt for the Inglewood project just to ensure that there is more of a distribution within that geography. So it really depends on the applications that come to us. I mean, we do our best to try to make sure that we're hitting a reasonably equitable distribution around the state. And so, at the end of the day, we kind of have the applicant pool that we have, and we kind of do our best with balancing that. So.
Yeah, thanks for coming, David. Appreciate you being here. And congrats on spinning up this huge program so quickly. It's almost a year since awards have started.
It's been a doozy.
Yeah. My question is about just sort of the intent of the programs and what we're seeing in terms of impact, and if there's any unintended consequences happening or things that are not happening that were intended to be coming out of these programs, things like that.
I think it's a good question, and I don't know that I have a great answer for you yet, just because it's still pretty early. I mean, I don't even know that I think we've maybe had 1 of our awarded applicants get to closing, I think, through the land banking program. And so, I mean, we're really, it's really just rolling out. And so, by the time when applicants come through, they'll come through the application process, we'll select them, and then they'll go through an underwriting process. And that underwriting process, anywhere from, 3 months maybe, something like that. And so, we're kind of just starting to hit the tail end on some of our first rollouts of that. But as far as unintended consequences, I don't think we've seen them yet. I mean, we've tried to anticipate it a little bit. And, there might be a question about if, is the program flooding the market with units? And in my opinion, no. I mean, it's a huge industry. Colorado's a pretty big state, and there's a lot of demand out there. And so, I don't know that we're going to see a significant negative impact from that. But again, I think kind of the intent was to make investments in new construction housing to keep prices from escalating as quickly as they have been. It's been a pretty unnatural escalation in prices lately, and I think the goal is to kind of get it back into a more reasonable window where you see an annual escalation of maybe inflation, basically 2 or 3%, maybe 4 if you're in a hot market. So but yeah, I think it's a little TBD on the unintended consequences. Maybe ask me again in 2 years and I can report back.
I was curious about the investment in modular home building. Are there examples in the metro area now of that type of home building?
Well, that was a very timely question. Yesterday, I believe, there was a big, they call it a box laying or box placing or something. Yeah, box setting, that's it. Yeah, that's what it was. And it was the project is over off of West Holden, I think, over in the Sun Valley area. And they had just finished constructing the concrete pier. So there would be a first floor like retail and mixed use. And then the next 5 floors are going to be constructed out of modular pre-built boxes that are coming from factories. And so they just finished doing that, and they're actually in the process of setting boxes now. So it's actually kind of an interesting thing to see, because it's they just kind of pick up this big, basically box looking thing and just dump it out. It's bizarre. But anyway, there are some examples. It's just really starting to roll out. You've seen it more commonly in smaller developments. There's been a lot of duplexes, maybe some fourplexes with modular, but larger multifamily modular is still fairly new for the industry. And so that development in particular is kind of on the, we'll say, cutting edge in terms of the modular industry and its growth. So. Yeah, I think it's over off West Holden. I don't remember the exact address, but maybe I'll see if I can look it up and get it to you before the end of the night.
It was in the Denver Post today.
Yeah, there was a story about it. There was a whole thing.
I was there. It was great.
Oh, you were there?
It was really impactful. Like he gave a presentation, and then like right after, like the box lifted up and moved over and said, it was very cool.
It's convenient timing. I tried to go see a box setting at one point, and the crane wasn't working, and it was just kind of just staring at the box. But we got to walk in the box, and it's really nice. I mean, the quality of product was really nice. So, go ahead.
Speaking of modular, in a way, modular kind of already exists in some forms. And I was actually just reading today about another mobile home park that's trying to create a co-op so that the residents can own that before another developer comes in and buys the whole place and basically says, move.
Right.
Is any money or any applicant going to get
So from Prop
money, or is this an
123,
entirely different world?
Prop 123, no, but CHAFA has worked with people that have tried to organize to purchase the mobile home parks that they're living at. We have worked to provide financing with them to support those types of acquisitions so that they can kind of prevent, market rate developers coming in and effectively evicting folks. So we have tried to work with folks that have been interested in organizing and purchasing the community in which they live. And so CHAFA does support that, just not necessarily through the Prop 123 program.
Okay.
Yeah,
Thanks.
we'll work with them to like provide financing and things like that to help make it work.
Just as a quick addition on the modular, the developer, Adam Berger, who set the boxes, did it yesterday, he owns a site off of Fox in Englewood that he's been trying to get a very similar project out of the ground. Hard with parking and all the different limitations he has.
Well, there you go. Maybe you'll have a front row seat to a box setting here in a couple of years.
All right, if there are no more, well, yeah, go Kevin, yeah.
I continue to hear you talking about multifamily units. Will you guys be working on these single-family homes?
So through the concessionary debt program and the equity program, no. DOLA will have some funds, and so this one's kind of a challenging one. So in the affordable housing world, there is recently, Ohio just passed something, it was a single family housing tax credit. And the idea was so that you can help subsidize the cost of developing housing and providing it at an affordable price to the development teams. And then that tax credit is passed on to the homeowner after they purchase the property. And so I've been following that and seeing how that's kind of worked out. I think it was just implemented like maybe this past fall. And so we haven't necessarily seen results of that yet, but there are some initiatives around the country that's going into doing that. But from Prop 123 specifically, the only funds that I know of that would be going towards homeownership would be through DOLA and their portion of funds. And then if some of the land banking applicants that came in had the intent to do homeownership housing on those land banking parcels, then there would be some homeownership opportunities through that. But the other programs that we administer are all through multifamily.
All right, thank you, David. If there are no more questions, we get to move on to Rose, who I think is joining us remote. So she is online, correct? Is she available? All right, Rose.
If she wants, I can, we're teammates, so I can
I was
operate.
I didn't want to put that on you, but since you're offering, we will graciously accept. Rose, your colleague David will advance your slides for you.
I got you.
Nothing? Okay.
Hey everyone, my name is Rose. Outcalt, are we ready to get transitioned over to housing tax credits?
Yes, we are ready for you, Rose, and your colleague David is going
We'll
to.
take that as a yes.
Yes.
Well, appreciate the opportunity to be here with you guys tonight, and for also the opportunity to be virtual. Again, my name is Rose Outcalt. I am a tax credit officer, so I underwrite applications that come in from developers for housing tax credits, and I've been with CHAFA for about 5 years. Next slide, please. So just a little bit of background about CHAFA. CHAFA was established in 1973. by the Colorado General Assembly, so we are celebrating our 50th anniversary this year. We are not a state agency, and we do not receive any direct appropriations, but we do have some members of our board of directors appointed by the governor. CHAPA uses bond proceeds for economic development and has been doing so since 1982, and approximately 35.3 billion has been invested and raised in Colorado to date. Our mission is to strengthen Colorado by investing in affordable housing and community development, and our vision is that everyone in Colorado will have the opportunity for housing stability and economic prosperity. So just to jump in and give some context, here is what we call the housing continuum. So everything in the tax credit program is kind of measured by percent of the area median income. And so you'll see everything on the spectrum from homeless to affordable rental housing would qualify for the housing tax credit program. And then middle income rental housing is that 80 to 120% AMI. And then home ownership, we have 50% and kind of above. So getting into the housing tax credit program, really at the crux of it is just that developers size their debt capacity based on the rents that they receive from renting out their units. And for affordable housing, because the rents are kept lower, that means that developers aren't able to kind of have as high of a debt capacity. And so that's leaving a gap between what it costs to build the product and then what the developer is able to source as a loan. And so just establishing that there are a couple different ways that affordable housing can be financed and created. One is through rent vouchers, so project-based vouchers, or housing choice vouchers, project-based being attached to a specific unit, housing choice being carried by the household or the individual family. And then the other major way is by subsidizing the asset, which includes housing tax credit, gap funding loans, grants, land donations, and then public funding, so like fee waivers or soft funding, etc. So the low-income housing tax credit was created in 1986 through the Tax Reform Act. It's administered by the Treasury. 3.7 million units have been created and preserved nationwide to date, and over 80,000 units have been impacted in Colorado in the time that we've been running our program. There's two main types of federal housing tax credit. There's a 9% housing tax credit and the 4% housing tax credit. The 9% housing tax credit is a competitive credit, and CHAPA is the allocator of this credit, and we are given the 9% credits from the federal government, and the amount of tax credits we get is based on a per capita rate. And so it is a finite resource, and that has led to a competitive environment. It provides a very deep subsidy, so up to 60 to 70% of the equity needed to fund a project. And it can be paired with state competitive credits for additional subsidy, and I'll get a little bit more into state credits in a second. The other type of federal housing tax credit is the 4% housing tax credit. It provides a shallower subsidy, and it actually is technically unlimited. So the federal government can give CHAPA as many as we need, but the limiting factor to 4% credits is that they have to be paired with private activity bonds, and those are also allocated to the state based on a per capita rate. So there is a finite number of private activity bonds out there. And so that's really what limits the total amount of 4% credit available. But so long as a project has the necessary private activity bonds, there will be, we can provide the needed amount of 4% credits. This credit can also be paired with state competitive credits to deepen that subsidy. And so we at CHAPA, we allocate these two types of credits throughout the year. So we have a funding round of 9% credits that starts in February every year. And just starting this year, we are awarding 9% credits with state credits. And then in August, we accept applications for state credits to be paired with 4% credits. And so those are our two main tax credit rounds. And we can accept 4% credits without state credits all year, just so long as the developer has the PAB to be able to support the project. And so this year has actually been a really exciting year for Colorado in state tax credits. Traditionally, we've had just standard state credits available every year in the amount of 10 million, and this year that program has really grown. So I think I'm getting a little bit ahead of myself. So the Colorado Affordable Housing Tax Credit is an offset against Colorado's income tax credit. It can be paired with federal tax credits, as I started to mention on the last slide, and they are allocated through a competitive process. So again, we have the 10 million allocation that we have traditionally paired with our round two, so the state and 4% round. And those have been authorized through 2031. And this year, through some success out of the legislative session, we now have 20 million additional dollars of state tax credits that have a little bit of a different structure. So we're calling them accelerated state affordable housing tax credits. And those are being administered now and have been administered already. In 2025, there are two new types of credits that we're working on creating a program for, and that is a transit-oriented communities tax credit and a middle income tax credit. So a lot more to come on those new ones. We're kind of in the research phase and the learning phase right now, and they'll be ready to deploy in 2025. So this infographic is just to kind of show you the lifespan of housing tax credits. So CHAFA, they start at CHAFA as the tax credit allocating agency. We then award them to developers of multifamily affordable housing who sell them to investors. And that money that comes in from the investors is really that influx of equity that helps these projects be financially feasible. And then the benefit to the investor is those tax credits then offset their tax liability through the IRS. So it really helps support these public-private partnerships through developers, CHAFA, investors, and really fill the gaps to make affordable multifamily possible. So there's a lot to see on this slide. I'll try and keep it really high level. I just want to go a little bit into illustrating the power of these tax credits. So the first column you're seeing on the left is kind of a conventional market rate project. So that would traditionally be 70% debt and 30% other equity. The 4% project, like I mentioned earlier, because the rents are lower, they can't get quite as much debt, so it might be 66% debt and then 34% coming from the equity from those 4% credits. And then the next two are kind of showing a high-level overview of what it would look like to finance projects that are in round one or round two. So starting with the 4% LIHTC and state housing tax credits, even less debt, 41% debt. You're seeing some soft funding in there. You're seeing some equity from the state credit and then equity from the 4% credit. And then all the way to the right is the 9% example where it's the least amount of debt, only 30%, with 60% of the capital needed to finance the project coming from the 9% LIHTC equity and then some soft funding in there. And that curve you see going through there, it says rents. It's illustrating that as the power and equity from the tax credits is increasing, the rents are decreasing. So for a 9% project, for example, you're more likely to see 30, 40, 50% AMI units being supported there versus maybe a 4% project would have all 60% AMI units or majority 60% AMI units. So definitely happy to answer questions on that. These two I'm going to just kind of skip over, but I wanted them to be in here for your future references. They're just kind of examples of a hypothetical 9% project and what the sources and uses are looking for. But it's kind of a repeat of what was on last slide, where we're seeing that the tax credit equity is about 63%. You're kind of seeing the developer can defer a fee. There might be money from the city or the state in addition to the permanent loan. And then on the right, you're just kind of seeing really high level of what the development cost categories are. And then this is also the same for just a state of 4 instead of the 9% in the last slide. So you're seeing a little bit lower federal tax credit equity, some state credit equity in there, and then a higher amount of permanent debt on this project, but still some of that gap funding, and then the kind of the same cost categories on the right. So this program, as I've mentioned, is very successful, and I think that is really due to these following 4 factors. It's really an incentive for the developer to agree to really long-term affordability. So on a lot of our projects that are competitive in the 9% round or in the state and 4% round, they're agreeing to affordability terms of 40 years. It really is helping promote those public-private partnerships with the private sector really assuming the risk for the project's success. So it's really helping in that respect. Because the 9% credits and the state credits are a finite resource, we've really benefited from competitiveness in our state. We have a lot of interest in the tax credit program. And a lot of really savvy and great developers. And so we see really high quality projects coming in because they know that they are competing for this resource. And then each state has their own qualified allocation plan, and I'll go into that a little bit, but that's really what provides our guiding principles, our criteria for approval, the kind of rules and regs, the how-tos around housing tax credits. So definitely our developers are very familiar with this document and are referring to it quite often. And so CHAPA's qualified allocation plan, as I said, describes the process for the application and allocation of housing tax credits. We update it every 2 years, and so we're actually in the process of updating our QAP right now. And part of that process is kind of internally making updates and then really receiving feedback from the community and from stakeholders for input on how to improve it and how to make it best serve our state. And then once that process is completed, it will be reviewed and approved by CHAPA's board and then signed by the governor. So just high level, our state is a little bit different than other states. A lot of states in their QAP, the process is purely, they're competing based on receiving points. In our process, we have kind of a threshold analysis where as long as projects meet kind of a base set of requirements, the analysis becomes much more qualitative. And so part of the qualitative analysis is what we call these criteria for approval. So things like really looking at the market conditions, the demand. We want to make sure we're spreading the credit around the state. So thinking about the proximity to other tax credit projects, project readiness, meaning ability to get through permitting and zoning and that whole process to get to close and to break ground, looking at financial feasibility. I mentioned we have a lot of great developers in the state, and so that's part of the analysis is thinking about their experience and track record, looking at project costs, and then also looking at the site suitability and kind of resources and amenities available on the site location. And then the other main set of considerations we use to guide our qualitative process is our guiding principles, and they're split up into these three kind of overarching categories of impact, diversity, and policy. And so I won't get into these in too much detail, but in impact, we're looking at really serving the lowest income residents for the longest time, looking at whether these proposals align with the Community Revitalization Act, looking at the efficiency of how proposals are using credit. Are they using the minimum credit they need to be able to be successful so that we can, support as many projects as possible, and then really supporting maximum units, the maximum number of units possible. So really looking toward density where applicable. And then diversity, again, distributing the resource throughout the state. So not just Denver, really looking to serve rural areas as well. We're looking to serve a variety of applicants and also residents, so looking at resident diversity and economic mobility. We want to have a good mix of new construction and preservation of existing units, so those are at rehab. And then lastly, in the policy category, again, looking at that kind of the site suitability, looking at proximity to transit and jobs, that topic of density, and then energy efficiency and sustainability, kind of moving toward all electric projects and away from gas supported projects to help with Colorado's green energy goals. And then the last thing is we do have 3 priorities, and projects that meet a priority are not guaranteed an award, but it is just an extra, more difficult, more expensive a type of application, and just this is our way of recognizing that. So we look at priorities for projects serving persons experiencing homelessness. So this would be in like a permanent supportive housing model where the design was really conducive to helping people transition from homelessness to being housed, and then with really intensive supportive services along the lifetime of their residency there. Projects serving special populations. So this might be like populations with a development disorder, this one is a broader category, but kind of similar, where they will likely need kind of more supportive services along their tendency. And then lastly, just projects in counties with less than 180,000 in population. So just trying to target those like rural, smaller counties outside of the major metro areas. And this is just a look back of the last 10 years. And so the yellow bar you're seeing is 9% credit applications that have been awarded. The blue is 4%. And then the green is the combination of state and for. So just you can see pretty consistently in the last 10 years, we've been able to support 600 to 700, 9%, 6 to 700 units with our 9% credit, excuse me. Much more variation in the 4% credit just based on PAB availability. And then you can see in the green kind of a wide range of state and 4% applications too. But in last year, 605 9% projects or units, 1,780 straight 4% units, and then just over 1,000 state and 4% units. And so some of the challenges we're facing right now are just high development costs and supply chain restraints. The interest rate environment has been challenging, high resource oversubscription, and then federal credit reduction. So for a number of years, there was kind of a bonus amount of 9% credits that we were able to take advantage of, and that has sunsetted in the last year. And so that concludes my presentation. Hopefully I stayed within my 15 to 20 minute period, but happy to answer any questions that you all have.
You did great. Can you hear us, Rose?
I can, yes.
Excellent, excellent. All right, are there any questions for Rose? Yes, go ahead, Samantha.
As far as the challenges, what do you mean by that high resource over subscription?
Just that with the state credits and the federal 9% credits being a finite resource, we always have more applications than we do, so consider like in the number of applications we have, the total request for credit from those applications is higher than what we have. And so, for example, in round one this year, which just concluded in May, I think we had 24 applications and we were able to award 13. And so sometimes there's, great proposals put forth, but we just cannot fund them all. And so we're seeing that in the 9%, and then we're also seeing that in the state credits as well. We have the state credit round coming up in August. We received a couple months before the round some letters of intent to kind of get a flavor of who's planning to apply, and we received 41 letters of intent. And traditionally in that round, we're able to fund 10 to 13 projects. And so last year, I think we were able to only award a quarter of the projects or a third of the projects who applied. So there's just always that kind of, we could use more resource if we had it, but because it is finite, we struggle with that oversubscription.
Okay, thank you, Rose. If there are no other questions, then we will move on to our next and final speaker, Troy. Yeah.
Hello.
Thank you.
Thank you.
Take one of these and pass it down. Take one of those and pass it down. I'm going to try and speak without the mic, and I don't have any presentation there. I've got some boards. What's that?
So we need you on the mic because it's recorded.
Sorry, let me grab my boards.
Yeah, and I'm happy to help however I can, if you want me to hold things up. Yeah, I can display the boards. I can hold a mic for you.
See what happens there. Okay, is that working?
Yes.
Perfect. I'm tasked with talking to you about public-private partnerships. I'm assuming we're talking about public-private partnerships about affordable housing. But I can't not mention that this building is a public-private partnership. This was the Cinderella City Mall, and the city ended up holding the bag on this, and that's why City Hall is in this building, because this used to be, a Macy's or something. So that was a public-private partnership that I don't know how it worked out for the city, but I do know that the city ended up holding the bag on it. I've done multiple public-private partnerships. And I'm going to talk to you tonight about two in more detail. But this is one where we were partnered with Urban Land Conservancy, who's a nonprofit. And yes, sir. Troy Gladwell. Medici Communities. So this was a project that we partnered with Urban Land Conservancy nonprofit. They own the land and we pay them a ground lease and it'll remain affordable in perpetuity. This is over by the 38th and Blake rails station going out to the airport. This is another project we just completed up in Arvada. It's very close, it's in Old Town, it's close to the light rail station there. It's 50 units, and the thing that's interesting about it is we bought the land from a nonprofit, another nonprofit, who worked really closely with the city, so we worked really closely with the city. It's a veggie van, and they source fresh vegetables from local farmers, and they load them up in a modified golf cart and carry them around, and cart it around the community and give and sell. And we built them fresh vegetables. And we built them an office space in there. We're leasing it to them for $1 a year for the next 30 years. Actually, I think it was $1 for all 30 years. And they're doing demonstration kitchens and stuff in that. So it's another form of a public-private partnership. The one I'm going to go into detail with a little bit more is the one that I just passed out to you. You should be familiar with this. This is there at Inglewood Parkway and Broadway. This is One Barrels. It's not Soho, but it's One Barrels in there now. And this was a public-private partnership where the city owned the land and the Urban Renewal Authority owned part of the land. And they put out an RFP, request for proposal, because they wanted to have something revitalized, have more people living downtown, and revitalize some of the area, bring in new stores. We competed with, I forget how many, Brad might remember, but 6 or 8 other developers competed for this. We were selected. Our commitment was to build as many housing units as we could. The Urban Renewal Authority did not want old red brick warehouse. I also built the one on Evans Station, and I wanted to do another old red brick warehouse, but the city wanted something modern. So we ended up with a modern brick building. That's why we ended up with that black building, black look. The big part of the public-private partnership was, this was all parking. And the business owners along the street didn't own that, but boy, they really got used to having that parking. And they thought if that parking's not there, it's not going to be good for business. And so we came up with a very complex parking plan. And there's parking that's just for the residents underneath this building, the Acoma building. And then there's parking that's shared parking on the street and here during the day so that people can come, shop, eat, stay there. And then this red spot there is parking just for the new commercial. You've got, I forget how many square feet, but I want to say it's 10 or 15,000 square feet of new commercial on Inglewood Parkway and the corner of Broadway. Our commitment was that we were going to have good, solid commercial in there. I'm not a commercial developer. I sold it to a commercial developer for a couple $100,000 loss on what it cost us to build it. But they got, real tenants in there and good restaurants. And so we really feel proud that we made that commitment. We followed through on that. The other project that I did that was pretty involved and complicated, again, involved the city owning the land. This is Florence Square. It's out on East Colfax, Colfax and Emporia. It's done really well. It's held up really well. We built it in 2003. It's still out on East Colfax, and it didn't change all of East Colfax, but it has contributed to making it better and moving it along, which is what the city was wanting to do at the time as well. It's 181 units. There's 2 phases to it. These are 14-unit buildings where every 14-unit building shares a courtyard, and the idea that once the neighbors sit in the courtyard and get to know each other, they're building community, and by them building community, they builds community with the building, and that helps build community and safety throughout. This is a commercial building right on Colfax. It is 3 stories on the ground floor. You've got commercial, which I have just recently in the last year finally got the last 3,000 square feet leased up, which is why I didn't want to do the commercial over here on Broadway, because I wouldn't do a good job with it. And it's more challenging on East Colfax than it is here on Broadway. But we needed a real developer, commercial developer doing that. Second floor is offices, and third floor is residential, and then the rest of the buildings are all residential. The city owned this parcel here, and they own this gas station. There was a gas station here, and they own that. And they contributed all the land, $1 million cash, out of their general fund. This was back in, I think, 2000, 2001. Aurora was really wanting to do something down here. And so we delivered what we consider, a really strong project. The public-private partnerships, I think, work better with nonprofits. I think that the city or the community, if you're giving money, you're giving something, you have to ask for something back. Don't just take what the developer will give you. Have a nice building, and I like brick. So that's it, unless you have any questions.
Okay.
Yes.
We hear so much about the challenges of developing in cities, especially when it comes to code or permitting or the time involved. If a city can't maybe offer land or funding, what else are you looking for in a partnership when you're doing a development in the city? How are you making those decisions? How do they translate to real costs for you?
Well, the city of Inglewood didn't have a lot of money. We actually bought the land. We're still making payments on the land. But they were very cooperative and helpful. You still have to do the building code. You can't, you have to pay attention to fire code. There's no shortcuts there, but how they work with you makes a big difference. And City and County of Denver has gotten to be really difficult. Inglewood was good. We just got through with a project in Sheridan where we just bought the land, but Sheridan has been great to work with. And, they help you get through the building code. They help you get through the zoning. They help you get, it's attitude. It really does. I'd love to do another project in Inglewood or Sheridan, and I'd stay out of Lakewood and Denver. It's hard to stay out of Denver. It's big.
What are the things that cities can do to incentivize partnerships beyond providing land, which is a pretty big one?
What are the other things?
Yeah, that, if you want to do a project here, how do we also attract that?
Having a cooperative environment really makes a big difference. Sheridan was unique in, when we went there doing affordable housing, normally the first thing they ask you get to city council is, well, how many 30% units do you have? Because you don't want too many 30% units because it's going to be a poor, more 50 and 60% units. Sheridan told them how many we were doing, and they were like, well, we want more. Our residents are 30 and 40%, and they've got a strong group of nonprofits working over there to provide support services to their residents, and they're organized, and they're going to help us lease it up. So, they're not providing anything, but they really are providing a lot. It's just with that being cooperative. But if you're going to do that, demand a good product too. Not just roll over. And I guess good architecture is in the eye of the beholder, but brick goes a long ways. And, people complain about getting through code and everything else. we need to build a safe building. You know, it needs to be reviewed properly. So sometimes I think developers just complain too much.
Troy, thanks for coming. Appreciate spending your time here this evening. And I love Evans Station Loft. It's a beautiful building. My question is, I think it's very easy for people, especially outside of the industry, to paint developers as greedy and even evil. What's your response to that? Obviously, you're providing a lot of affordable units. You're doing public-private partnerships throughout the metro. What's your response to sort of being painted in that way?
Well, I'm not greedy.
Well, I'm not. I know that.
No, there's developers that don't see, they have no architectural taste. All they see is the bottom line. And they don't care about the community they're working in. And maybe they're happy, but it's not the way that I would have done business and would want to do business. It's much more rewarding to work with a community and, build a better product at the end of the day. But are there developers out there? Yeah. And are there other developers? Yeah. So, they're not all, I was telling Nancy, my general contractors, BC Builders, the only guys I've used in my entire career. It's been 23 years with this guy. And if he retires, I'm done, because they say the same thing about contractors. They're greedy and they're trying to steal, and they are, except for Bob, BC Builders. So, and it's like, this makes my life easy. I don't have to worry about this. So, yeah.
I have a question. Would you be able to do the Inglewood project today based on the same exact factors?
Well, yes, we could do a project. Would it be the exact same project? That's hard to say. The construction cost, I was telling Brad, I forget how much we paid for construction per unit or per square foot on that. But I know on Florence Square, that was back in 2003, it was $85 a square foot. So that's kind of different. Construction costs on that product now is $280 a square foot. Which is really, it's gone up dramatically. And then the interest rates have gone up. And fortunately, state of Colorado voted in Prop 123, and CHAFA does an amazing job getting that money out. And that's helping to fill some of these gaps. So yeah, it's because we're getting more money right now. And hopefully, construction costs have stabilized. Hopefully they'll come down a little bit. But you're always able to do it because there's a lot of different levers you can pull and pots you can pull money from to make it work. On that project, it fell out of being a QCT on the one on Broadway. Like December 25th, I got a call from my partner and he said, "Boy, you're not gonna like me. Not being in QCT, you lose 30% of the equity, extra equity. If you're in a QCT, you get 130% of the 9% equity. If you're not in a QCT, you only get 100% of the 9% equity." And that's what happened. And the county had another $1 million, Arapahoe County came up with another $1 million in home funds. We turned the loan from, I think we were gonna pay $700,000, or no, we were gonna pay $1 million and have a $700,000 loan, and they let us flip it. Now we had a $1.2 million loan, and we're paying on the $1.2 million loan, and we only paid $500,000 at the closing. So we pulled some levers to make that happen. Oh, and we partnered with the Housing Authority. By partnering with the Housing Authority, you don't pay property taxes, which lowers the expenses, which helped us take a bigger loan. So that's another way that it's a public-private partnership. So all of those things came together. Normally, I wouldn't go and ask for a partnership with a housing authority unless I need it. And with $280 square foot cost, you pretty much need it these days. Or $210 for a 3-story wood frame walk-up. That's a different type. We're building the one in Sheridan, and it's a 3-story wood frame walk-up, and it's coming in at it. I think it's actually coming in at $190 a foot, but that's because we started construction last year instead of this year, and now it's up to $210.
I wanted to add a little context to that too. So, we obviously see a lot of applications come through our door. And so I always like to ask groups that don't work in housing development how much they think a typical like 1 or 2 bedroom apartment unit costs, like a per unit cost. Anybody want to throw some numbers out there? Yeah, like that building right there. I don't know the exact number on this one, but I can give you the average cost per unit, like per one of those 1 or 2 bedroom units. How much do you think it costs?
100 grand.
Any other guesses? What's that?
Closer to 2.
Keep going. Today's average-ish construction cost is usually between $300,000 to $400,000 per unit.
Yeah.
It's very expensive to develop housing, and that's something that is just, I prior to coming to CHAFA, I worked at the Ohio Housing Finance Agency. I was the director of multifamily housing there as well, so I'm very familiar with the world of tax credits and whatnot. And that is, I think, a very underappreciated factor that goes into housing development is the timelines are extraordinarily long. The numbers are very large. It is extraordinarily risky. And to your question earlier about, people tend to paint developers as very greedy. At the end of the day, he may have a project he's been working on for 3 years before he even sniffs walking into a bank or a tax credit application.
I wish it was that good.
Right. And, he's probably put $250,000 into it before he's even applied for the credit that he may not even get. And so it's, it's a very different environment. I didn't really have a full appreciation for it until I started working in the industry. And now that I do, I've kind of make it a point, especially when I'm coming out in public settings like this, to just kind of ask that question, because I think there's a mismatch of, kind of a different set of facts for folks, right? And I think people perceive developers as greedy sometimes because it's like, maybe it's 100,000 a unit or something. And it's like, keep going, and it's a very challenging business. It's a very risky business. And a lot of people hate you. And it's, I don't necessarily always envy, developers in the positions they find themselves in, especially there are some developers out there that are just not great. Like that's, so you can find that in any industry, right? But there are plenty of developers out there that are great, that really do want to work through public-private partnerships, that really want to work with the community and find something that the community likes and that will benefit the community. And so, by and large, a lot of the developers we work with at CHAFA are just like that. I mean, they're very mission-driven, and their goal is to provide, affordable and decent housing for people, and that's really it, right? So, I just wanted to add that kind of context in there, because sometimes it's just when you speak about it in square foot numbers, I know what you're talking about, but it's kind of hard to visualize. But when you think about just walking into like a 1-bedroom or a 2-bedroom apartment and thinking about how much that costs to build, it kind of, I think, contextualizes it a bit.
1,000 square foot unit, 2-bedroom unit, that's at $280 a foot, that's $280,000. Just the hard construction costs. And yeah.
I was going to add one thing to that. The other thing with developing housing, especially rental housing, affordable or market, is oftentimes that market housing gets sold to investors. And those investors could be here, but they could also be nationwide. They could be global investors, where more often than not, affordable housing is owned by the housing authority, or do you own all your properties still?
I did the Florence Square one on East Colfax, first project, started in 2000, it was construction in 2003. I own it.
Yeah, and so there's that.
Own it, pass it to my kids.
Community investment when a nonprofit, a local developer or housing authority develops that because they have a stake in that community. Whereas that market development, it's an asset. Somebody sells that asset to some large firm and they treat it like an asset and they run it like an asset.
Right, and if they're asking you for a public-private partnership and they're not doing any affordability, they're just in with their hand out trying to get money, don't do it. And this is what's the public benefit? I'm a taxpayer. We all are. We're standing in a building that didn't work out very well, for the community, and that was for commercial use. So that's my soapbox.
Troy, I do actually have a question for you around, you mentioned just being attuned to community needs or community interest in your public partnership endeavors. And so how do you make sure that you're listening to what community wants? I mean, you gave us that example with the parking on Broadway, but what's your principle and your approach?
Well, you have lots and lots of meetings.
Touche.
And, I typically start with a project with a very schematic building and a very schematic site plan. Because if I've spent $150,000 and I come in and you don't like it, I just want to dig my feet in and convince you that you should like it, because, we spent a lot of money having the architect and engineers do this. So come in on a schematic level and listen to what people have to say. And what they want. And then when you come back, modify your plan, tell them why you can, this was a great idea. And I hear you wanted me to do this, I can't do it, and here's why, and explain it to them. I had, 23 or 24 neighborhood meetings on that one in Florence Square.
Yeah.
That was,
Yeah, I believe it.
that was a lot.
Believe it.
But it's fun meeting with you guys, so I don't know.
Yeah, thank you, Troy.
Yeah, anything else? All right, thank you.
No? All right. All right, well, before we segue, we do have an introduction that needs to be made, yes? Yeah. I will open it.
I just really quickly want to introduce Jessica, who's over here. So Jessica Cox is in a role that is funded by the cities of Inglewood, Sheridan, as a Tri-Cities Homelessness Coordinator. So we've had this role for about 3 years. 3 cities worked with the county to develop a plan. We've done a lot.
Are you on a mic?
57% of the plan has been completed. The main focus that we've been working on is a governance model, and one of the things that called for was the creation of this position. So there was an incumbent who was in the position for about 2.5 years. And one of the things that we have not gotten to yet is a permanent supportive housing study that is in our plan. And so Jessica comes to us with a lot of experience in housing. When she heard about this group, she wanted to come, and so I'll just give her a quick second to introduce herself.
And Jessica, if you could, as you get your mic set up, could you please say your name again and your title, just in case we missed it earlier? Yeah. So if you just hit there we go. Yep, perfect.
Hello, everyone. My name is Jessica Cox. I am the new Tri-Cities Homeless Service Coordinator. And I come from most of my career being in housing. So I started at Mercy Housing, where I supported single-parent families, getting them from transitional housing to permanent housing. And from there, I worked at Innovative Housing Concepts for 4 years with Lindsay, and I started their resident services program. From there, I went to Aurora Housing Authority, where I just kind of finalized and launched their opportunity and self-sufficiency program. And from there, I worked a little bit more clinically. Just for some context, my master's is in developmental psychology, but my passion is really in social work and community work. So I'm really excited to be in this role and to support a lot of the Tri-Cities efforts for expanding housing.
Excellent. Well, thanks for being here. Jessica, thanks for joining us.
Yeah, thanks for having me.
Absolutely. All right, so this is the part where you all get to converse some more in the breakout discussion. And what we're going to do, remember this with Glenna, that she did with us the 1, 2, 4, all. So what I'd like you to do, and I can pass out Post-it notes if you need this, but we're going to spend about a minute, and I'm going to time you through all of these. You'll spend a minute just individually reflecting on this question, like how might partnerships be a tool to address affordable housing in Inglewood? So just individual reflection, write that down, and then you'll get grouped in pairs. And Jessica, what we do, we don't include staff in these breakouts, so you're off the hook. But if the task force members could get then in pairs and then exchange your ideas that you wrote down individually, and then you'll get grouped in 2 pairs, and then you'll exchange your ideas that you talked about as pairs, and then you'll share out some of the highlights that you heard as a group. So everyone remembers how we did that. I think some folks might have not been here the last time, but so I'll help guide you through this. I think if I counted correctly, there might be a group of, right? So, got it, thank you, Diane. So I think we're gonna figure this out. So if we could just figure out we're just first spend a minute, Feel free to think about, you do not have to pair up with the person next to you unless you want to keep it convenient, but think about who you want to partner with after you do your 1-minute reflection. So, giving you a moment to reflect on the question, and then I'm going to start the timer. If I can remember my passcode. Oh, thank you. Perfect. Okay, that's wonderful. Okay, thank you. All right. Go ahead and get started. Five seconds. All right. Okay. All right, so you can go ahead and get in your pairs. I do think that there's one group that's going to have to just be a pair of 3. Okay? Who would like to be a pair of 3 with Joseph? Heavens, you're Corey's here. Okay. And then, let's see. Is that going to work out right, or did I accidentally push people? Yeah, I did.
3.
2, 2, and 2. Yeah, perfect. All right, so you're going to share for 2 minutes in your pairs or trifecta. All right, go ahead and get started. Talk about something else. I don't know. You got a minute. I know. Oh, I need to connect with you. Okay. Oh, because it's my business, my LV Jones. That's why. Yeah. Yeah. I know. I wasn't supposed to be here. All right, 10 seconds. Okay, so now, as you're wrapping up your conversations, what you're going to do is you're going to group in pairs of 2 pairs, right? So 4 and 5, or 4 and 5. You get to go wherever you want. Just make sure that it's either 4 and 5. And one thing that I want you to really think about is, I feel like everything that we heard today was really reflective of the strategic vision that you all created as a task force. And so I saw a lot of mission and such threaded through. So as you come together and share your ideas that you discussed as pairs, I hope that you'll be reminded of a lot of that was threaded through today. But the objective, after you exchange your ideas as groups of 4 and 5, is think about, you're going to share out later like some of the highlights of what you heard. So be noting, and I'm going to give you some chart paper if you'd like, but be noting like some of the highlights of what you heard. Okay? Do you want to note all of your thoughts on chart paper, or do you have scribes that you feel like can just handle it? I mean, you're very high tech. All right, let's do it. Not yet. All right, go for it. 4 minutes. So what we'll do is when they share out, you can go, if you want, you can put it on the wall, or you can just do it from here. I thought I was going to give them these, but I ended up not doing it. So, what's that? Yeah, whatever. Yeah. And then, yeah, if you want to go ahead. What's that? Yeah. Thank you. Thank you. You're going to be awesome. High five, you got this. One minute. 10 seconds. Could you guys benefit for 5 more minutes? You do? Okay. So advanced. Could you use 5 more minutes?
I think we could keep talking about it for a while, but I think
Right?
I don't know.
You don't need? Okay. Well, we do have time. That's why I just wanted to, if you need more time, let's open it up. We'll take all the time we need in the group share out. How's that? Okay. All right. So what I'd like you to do is each group, who's going to be your representative and speak on what were some of the highlights. Or actually, you know how I want to do it? I want, like, for example, Sophia and Hugo, you share what you found most notable about what this trio shared with you that you found really interesting. And then you will do the same. How about that? Okay.
She made eye contact with
Sophia or Hugo, who would like to be your pair's representative? Okay. I know it's kind of different.
I think that we were all kind of coming at it from the same angle of obviously having it, as many people involved as possible, nonprofits, people involved with the local government and private industry, and having as much communication opportunity as possible is clearly a very good thing.
So collaboration was very
Collaboration,
important,
yeah.
right? Okay.
I mean, it's really easy to sum up what their concept was, which was that partnerships are essential.
I forgot the only word.
Yeah, that was it.
Partnerships are essential. Hashtag. Partnerships are essential. Love it. Thank you. Kevin, would you like to? Okay. It's going to be.
Yeah, it is essential, trying to get as many people involved. Prop 123, we're talking about the amount of money that's coming in. And I know they're overextended, and I know there's more and more people or communities that want a piece of that pie, but I think if they're diversifying the communities that get it, Inglewood will have a great opportunity, right?
We applied and got denied last time, but we'll keep applying.
Right. Well, eventually they can't give it to Sheridan every year, right? So, and so for us to be ready and have a strategic vision for that opportunity when it does fall in our laps.
I love that. So be ready when, not just the opportunity, but when the opportunity is ready to build, right?
Yeah.
Yeah, so be ready. And then follow the strategic vision, have a vision and follow the vision. Okay, awesome. Great. Great job, round of applause, if you care. All right, how about this group? And so I'm doing a little different, right? But would you two like to share what this dynamic duo, what was notable about what they shared as a pair with you? A highlight.
I think they touched on that partnerships could bring in Prop 123 funding because maybe that developer wouldn't have experience in getting that funding from before and know what they're looking for and help people get that.
I'm sorry? Oh, yeah, thank you. Okay, so rehearse what you were just saying. You get to do a do-over. And then say it into the mic.
I don't know how right it was. So I think they said that Prop 123 funding or partnership would help Inglewood because a developer who has past experience in Prop 123 funding would help Inglewood navigate that potentially and bring in that funding.
So bringing experience to the table.
Right.
Helps the greater likelihood.
Yes,
of
past
bringing-
experience.
Yes. Of delivery. Yes, I like it. Okay, I love it. I love it. Okay. Aaron? Sophie?
you go.
Samantha? It's going to be Samantha? Okay.
Sure. No, it's okay. I think they said something very similar to the essentialness of the partnerships, not just how might it be a tool, but for Inglewood specifically because of its size.
Ooh, yeah.
And we're, I think, even smaller than the other cities in the Tri-Cities. As far
Can you
as,
say that again, but bring the mic a little closer?
is this better?
Perfect.
Oh, hi.
Oh my God, you're in stereo. I love it. Okay, so that last part, you say that again?
For the size of Inglewood,
Yes.
the essentialness of multiple partnerships, just based on our size alone, we don't have as many resources or money or knowledge base or experience as Denver, sure, but even other surrounding cities. We're even smaller than them. So it's not that partnerships are going to be a tool, but like they also said, they'll be essential.
Again, because of the experience and the, right?
Yeah.
Yeah. Awesome. Awesome. Thank you. Is there anything that time did not permit you to share that you want to like share out with the full group? Are there any other ideas that you didn't get to touch on about how partnerships can be a tool?
Yeah.
Like, what are we missing? Yes,
I have
Aaron.
one. Well, and to go back a little bit, I mean, we kept it high level in that this is a huge problem. It's hugely expensive. It's hugely risky to develop housing. So, like they were saying, partnerships are essential. A point that I didn't get to is that I feel like Inglewood needs to make it attractive for the right kinds of development partners to operate here. Troy talked about it being difficult in Denver and Lakewood, and some of that's the permitting process or the site review processes. Sometimes it's available local funding to put into the projects and the capital stacks. In order to make partnerships really work here in Inglewood, we need to make it attractive to the right kind of developers.
And so are you suggesting like an incentives program that would, or are you solely talking about, no, make permitting easier? Period,
All of the
etc.?
above. I mean, we've talked about incentives in terms of inclusionary zoning and housing like that, of bonuses for density, reductions in parking, things like that. But all of the other things that we've been talking about for the past several months, and specifically funding, helping to share some of the risks in projects. These are the real challenges that keep development from happening in some communities, and we want to be the opposite of that.
Steve?
I would also say that it's really important that leadership within the city, council, so on, identify these locations for the project before you even go out there hunting for a developer to develop it. Because as a city, you really kind of need to know what you're willing to do if you want to make this thing happen and happen cost effectively. Because I was involved with the project with Troy.
Okay.
And that went on for quite some time. There was a lot of community battles to it. Troy, I got to say, he was an excellent person to work with. He was always concerned about the community, and he is right. There are a lot of developers that will say, "Oh, just give me, and I'm not going to really bring anything to you except a building." So if we know as a community what we want to develop, not necessarily saying exactly what we want to develop, but this spot right here, we're willing to do this, this, and this, then we can start putting it out to the community and see what developers will bring to the table. And then you get to see how they react, if they're demanding or if they're wanting to work with you, or what are they willing to bring to the table to get this project. I can't say too much more about how good Troy was to work with, but he was very responsive. And there are developers out there where some of the other developers, because I was involved with the Ironworks project too, and they did a nice job, but it wasn't to the same level. And Troy's property was extremely difficult to work with because of all of the restrictions, and he truly worked with the community to come up with a plan.
I think you make a great point,
too.
because at the end of the day, it's so expensive to develop. It takes so long. These developers are so invested in it that when they're going to choose which development I want to do, they're going to go to the development that has the most support behind it, has the most need behind it. And so if a city can show that to developers to say, this is what we want and we're going to support this, then a developer's they're going to go for that because they know there's support behind it, because they know it's not just them trying to push a vision, they're executing on somebody else's vision. So I think that's how Inglewood can attract more partnerships is by creating that vision to attract more developers that I think would feel more comfortable in developing with that.
Hugo.
We talked about a concept, and Steve maybe talked about it a little bit there with, the city kind of maybe leading the charge a little bit of having, like, how do we access the funds? How do you bring in and create these partnerships,
Right.
Short of a developer doing it on their own or a city going out and doing an RFP to find somebody for a particular site? Like, could there be a role, not dissimilar to, thank you for joining us tonight, but to
With Jessica.
a person who's there to connect? Like, if the city could hire somebody, we could do one more development in the city. I mean, that's a worthwhile role for that person to be sitting in, especially when all these new programs, whether it's Prop 123 or tax credits or other stuff that's out there for TOD types of developments. Like, how do you streamline that and make it easier for these partnerships to be created and cultivated that will ultimately lead to more development?
That dovetails off of what Aaron was saying, even like creating the systems, the program, what have you, make it easier.
It's like a community development person for this specifically.
Okay. Anything else that's missing? You guys covered a lot of ground. I'm inspired by what you shared. I'm so glad I got to come back because I get to hear like just the momentum you're building in trying to synthesize what you've been learning and then working together collaboratively as a group to ideate, think about like what are some ideas, what are some potential recommendations or suggestions or what have you. And these felt really strong to me. I'm glad we were able to capture. Thank you so much to our amazing note taker. But I also know that you probably have some remaining questions, some things that you still don't know or still don't feel like you can fully get to that point, what that's going to happen in September, right, where you're kind of bringing these cohesive ideas together. And so there will be a slide that you can get your phones out and do the QR code and share what you feel is missing, what more you need to know, or how I can't answer what I don't know just yet. I can't formulate recommendations because I still don't feel like I'm there yet. I think what was really important, I'll pass these around in case you want to take it home and do it later, but or Steve can pass it down. If you take one and pass it, just one, and then pass it to Sherry, and then she'll pass it. Just so you can each, and if you want to take one, you don't have to. 5. But I think something that's really important to Glenna is that as she's helping you get through, next month you'll have another education session, but once you get to September, it's really important to Glenna that she's able to bring that cohesion from the past 9 months and that you feel like prepared and ready to engage in that type of brainstorm, that type of work, that type of conversation. And so if there's anything that's missing here, this is your opportunity to help inform her how she gets you ready for that work September through December.
What's the date of the meeting in September?
In August, it's August 1st.
Wait, September?
Oh,
The
it's
September meeting.
Sorry, I didn't hear.
I have it on my phone, I'll pull it up. Thank you. It's like the first Thursday in September,
September
right? Yeah. Does that help, Hugo? Good? Oh. Yeah. Yeah. Okay. So next, so this is the cadence. Effect August 1st will be your next meeting, which I believe we get back to the recurrence of the first Thursday of the month. July was just different because I hope everyone had a great 4th of July. But yes, so this is the QR code. If you wanted, you sent you with the handouts to take home to do that later. You got your next meeting. And I would love it if everyone can just do their I like, I wish, I wonder. You could take 5 Post-it, Steve, and pass them down, or you can keep them all to yourself. I've got examples of what the I like, I wish, I wonder Post-it colors are. Of course. And then let me know if you need pens or if you want a marker. You good? Okay. Marker, pen. Yep. No, you're good. Marker, pen. Oh, did I not give you one? What? Here's all the markers and all the. Thank you. And then David, the loan officer, left some of his, the Chatha gentleman, he left some of his cards. I'm going to put them on the table if you want to take them when you leave. I know, I wanted them to. I was trying to use recall. I was like, how did I do it before? Dang it. I'm glad you called me out on that because I was trying to remember. I mean, that's it. You're free to go. I know. Thank you. Oh, here, let me see. I can have my mic off. You can turn.